Gold is no longer moving randomly. What you are seeing right now is institutional distribution in its purest form. Liquidity is being engineered, structure is collapsing, and smart money is preparing for the next major expansion move. Let's study the chart in detail. In this breakdown, we'll decode gold using tier smart money concepts, institutional liquidity theory, and price action. We'll analyze the higher time frame narrative first, then drop into the 15-minute execution model to identify both buy and sell opportunities with exact levels. The first thing institutions observe is structure. On the 1-hour time frame, gold is clearly bearish. We can see a sequence of lower highs and lower lows forming consistently after the major rejection near the strong high around 4,720. Notice the displacement candles during the sell-off. This is not retail participation. These impulsive bearish candles indicate institutional activity, strong imbalance, aggressive order flow, and clear downside intent. Before the breakdown, price spent time consolidating. This is where liquidity was engineered. Retail traders interpreted this as support, but institutions used the range to distribute positions before collapsing the market lower. This change of character was the first warning sign. The moment bullish structure failed and price broke below support, the market narrative shifted from accumulation into distribution. Institutions don't chase price. They chase liquidity. Every equal low becomes a magnet because that's where retail stop losses accumulate. Smart money targets those pools before deciding the next expansion phase. This supply zone is extremely important. It represents the last institutional selling area before the breakdown continuation. Until price decisively reclaims this zone, sellers maintain control of the market. The current low is labeled as weak for a reason. Weak lows usually attract further liquidity sweeps because price has not yet shown strong rejection or accumulation behavior from institutions. Most retail traders buy during these temporary pullbacks, assuming gold is oversold. But institutions use those emotional reactions to create liquidity for further selling pressure. Every break of structure confirms continuation. Institutions are systematically removing bullish support levels and forcing trapped buyers to exit positions at a loss. However, there's something important happening now. Momentum is slowing down. The recent candles are smaller, indicating possible absorption near the lows. This often happens before either a relief rally or another engineered liquidity sweep. The entire narrative becomes clear. Institutions distributed positions near the highs, manipulated traders during consolidation, and aggressively expanded lower into liquidity resting beneath structure. Professional traders don't predict markets emotionally. They react to liquidity. Right now, price is trapped between a higher time frame supply zone above and vulnerable liquidity below. If institutions decide to rebalance inefficiencies, gold may retrace upward into premium pricing before continuing lower. This is how smart money creates optimal entries. Strong bearish displacement tells us one thing clearly: sellers remain dominant. Until buyers reclaim key structure levels, every rally remains vulnerable to institutional selling pressure. Notice these equal highs forming during the pullback. Equal highs attract buy-side liquidity. Institutions often sweep those highs first, only to reverse price aggressively afterward. Now let's move to the 15-minute time frame where institutional execution becomes visible in much greater detail. On the 15-minute chart, the bearish narrative remains intact. Internal structure continues forming lower highs and lower lows while liquidity is repeatedly engineered above temporary highs. This consolidation is extremely important. Price is compressing after an impulsive sell-off. Compression usually leads to expansion, and institutions are preparing for the next liquidity event. These equal highs are not random. They represent resting liquidity. Retail traders place stop losses above them, and institutions use those stop orders as fuel for future reversals. This change of character confirmed the internal bearish shift. Once price failed to sustain higher lows, smart money transitioned from accumulation into aggressive distribution. This displacement candle matters because it created imbalance. Imbalances often attract retracements later, but they also confirm strong institutional participation. Look carefully at the bullish reactions near the lows. Buyers are reacting, but they lack conviction. Strong reversals require displacement. Right now, we only see hesitation. Below current price sits another layer of sell-side liquidity. Institutions know this, and unless buyers reclaim structure, price may continue hunting stops lower. This lower time frame supply zone is the key reaction area. If price retraces into this zone and shows rejection, institutions may continue the bearish expansion. Institutions rarely move price in straight lines. They engineer fake bullish momentum, first encouraging breakout buyers before trapping them and driving price lower. Elite traders don't trade emotions. They map liquidity. Every candle becomes easier to understand once you realize the market is designed to transfer money from emotional traders to disciplined traders. At this stage, we have two possible scenarios. Either institutions retrace price higher into premium supply for selling, or buyers reclaim structure and trigger a short-term reversal. Now let's break down the exact execution plans, including entry zones, stop losses, and liquidity-based targets. The primary sell setup comes from a liquidity sweep into the 4,500 to 4,510 supply zone. This is where institutions may rebalance inefficiencies before continuation lower. The ideal sell entry is near 4,505 after bearish rejection confirmation on the 15-minute timeframe. The stop loss should remain above 4,522 beyond the liquidity sweep and structural invalidation. The first target is the current week low near 4,460. The second target sits around 4,435, where deeper sell-side liquidity is resting. This setup provides a strong institutional risk-to-reward profile. Do not blindly sell the zone. Wait for confirmation rejection wicks, bearish engulfing candles, or a lower time frame break of structure after the liquidity sweep. This setup works because institutions exploit breakout traders. When price sweeps above temporary highs, breakout buyers enter aggressively, becoming liquidity for institutional sell orders. As long as gold remains below the higher time frame supply zone, bearish continuation remains the higher probability scenario. Now let's discuss the counter trend buy setup. This scenario activates only if institutions begin absorbing sell pressure near the lows. The ideal buy entry comes after a confirmed bullish break of structure above the recent 15-minute highs. Entry zone is around 4,462 to 4,465 after confirmation. The stop loss belongs below 4,448 beneath the liquidity sweep low. If price breaks below that level aggressively, the bullish narrative becomes invalid. The first bullish target sits near 4,490, where short-term liquidity rests. The extended target is the lower time frame supply zone near 4,510. But remember, this is a counter trend setup against the higher time frame bearish structure. That means confirmation and disciplined risk management become critical. Professional traders never enter before liquidity is taken. Patience around liquidity sweep separates disciplined execution from emotional gambling. Always align lower time frame entries with higher time frame narrative. Selling from premium pricing in bearish markets dramatically increases probability. Institutions target obvious stop losses. Never place stops exactly at visible highs or lows. Give your trade enough room beyond liquidity. This is how institutions move the market through liquidity, manipulation, and structure. If you want more professional smart money breakdowns on gold and forex, subscribe now, because the next move may already be forming.